Hello and welcome. My name's Ali Goff. I'm the owner and founder of Goff Legal, and this is a continuation yet again on our gifting conversation. These are bite-sized, small bits of information designed to get you a little more information to take back to your tax advisor, because I am not your tax advisor, on some strategies that you can use to help lower your taxes. We talked earlier about lifetime exemptions and annual exclusions. We then talked about medical expenses, spousal gifting, and education. And now I'm going to spend just a little bit more time on a few gifting strategies that impact not only your future estate tax liability, but your income tax. All the other things we talked about really only limited your lifetime exemption of gifting. But these, we've got a double duty. We're having some fun here with taxes. So remember, life exemption, you can give away a certain amount of money during your life and after your death without paying, no one pays any taxes. But what if you have enough income right now that you don't like the amount of money you're currently handing over to the government? That's where these strategies come in. So the first one is a donor advice fund. These have become much more popular in the recent future. We sort of label these as a family giving account. You can make a tax deductible contribution now, I mean tax deductible as in you pay less taxes, right? We've deducted money off of the top line of your revenue income for the year. And you can decide where to give it later. You don't have to give it right now, and it grows tax free. So if you had some example, you put $100,000 into a brokerage account today, there's no tax exemption on it, no tax deduction. It starts to grow. And let's say it goes up to $150,000. You've paid income tax every time it generated money. And when you sold it, same. Now, let's say you take $100,000 and put it into a donor advised fund. You get immediate tax deduction. So you save some money on your taxes, work with your tax preparer, your CPA, your tax strategist on how much it will save you. And it grows tax free. So that $150,000, that $50,000 of growth, you didn't have to pay taxes on it. So if you're thinking about giving money, if you're putting it into a donor advised fund, it can grow and you can make a bigger impact and you'll pay less taxes. I think it's a win-win, honestly. What's nice is, like I said, you don't have to make a transfer out of it in the same year that you put it in. This is great if you want to involve maybe your kids and grandkids in giving. You can say, I've got a donor advised fund. Who would you like to donate money to? And it can come out of that account. So it also, by the way, when you put that money into the donor advised fund, it removes it from your estate. We talked about in the first video, you have a lifetime exemption. You can give away $13.99 million currently. It's set to go down to $7 million next year away. Now, if you had $20 million and you took $2 million and put it into a donor advised fund, you now only have $18 million left in your estate. All that money that went in there because it's going to a charity is not included in your estate. Cool, huh? I think it's cool. All right, next up, let's go through qualified charitable distributions, often termed isn't a word, termed QCDs, qualified charitable distributions. This works if you're over 70 and a half and you have an IRA. A lot of times you are taking money out of your IRA because you have to have required minimum distributions from these retirement accounts. This is how it works. You take the money out, it goes into your account, you pay taxes on it, and then you donate it to a charity to help limit your taxes. Well, did you know that you can take it directly from your IRA, have it go to the charity, which means it's the 100% is going to go to the charity and the taxes won't be taken out first, which means you can give more money without giving any more money. The same amount of money you would have taken out and then given them less, you can give them that same amount and it goes directly to the charitable organization. There are some limitations on how much you're allowed to do every year of this, but talk to your tax professional about how this might help you, or talk to the nonprofits. They're getting really good at knowing how this works, and you can talk to them about tell me about this QCD, and they'll go, we'll tell you. Let us help you. And then lastly, by the way, there are so many more tax strategies. I'm not going through all of them. I'm going through sort of the big three. Charitable remainder trusts. So one of these things that you can do is you take usually appreciated assets, assets that have grown during your lifetime that if you sold, you would have an immediate tax hit. You take these assets and you put them in an irrevocable trust. The trust, then you get a partial tax deduction based on, a bunch of different factors. Talk to your tax professional. The trust pays you income for your life or a certain number of years. And when you pass, the remaining amount goes to charity. Sometimes you can have it go to your kids and then go to charity. A lot of times we're putting assets in there like large stock positions or real estate. Again, what you put in there is really important. Your financial advisor, CPA, and estate planning attorney should be coordinating on this. This isn't I'm going to DIY these kinds of things. Nothing in this video is DIY. A lot of it will require chatting with an advisor so that you do it right. If you do it wrong, the IRS goes up, we'd like our chunk. If you do it right, more money makes it to your family, more money makes it to charity, and you can have an income tax deduction, more money in your pocket. Really, it's a win-win-win, but you've got to do it right. So it's really important. If you want to talk to someone in our office about the estate planning aspects of this and coordinating with your advisors, gofflegal.com is the best way to get information and schedule an appointment.